milestones like marriage expenses, child education, or retirement, maybe go traveling or whichever. So there's different milestones in life that you want to plan for. So there's a key reason of why we actually want to invest. So you have to look at the real rate of return of your money. Okay, basically inflation is going to erode purchasing power over time. So if you look at if you keep your money in the cash balance, right, you hold the money value for sure, very stable, very safe. But Singapore banks give generally in a saving account 0.05%. Even if they give you a better one, maybe you go to the higher interest account, you look at maybe 0.9%, 1%. Okay, basically 1% is not bad. Yes, it's not bad for a cash, very liquid holding for your cash reserve. But if you think of holding a lot or massive amount of funds in the 1% or less than 1% type of return, you'll be actually losing value of money over time because inflation in Singapore is at 2+%. Okay, even if you look at the pure food and accommodation, you're looking at 2 to 3% over the last years all the way. Okay, so if you put anything that is below the inflation rate, you will have a net loss of real purchasing power itself. So you're trying to see if your investment itself can be in a return, which is the nominal return, can be beating, mean it's higher than inflation rate, then you get a real return that is positive to you. Okay, so if you leave the money in the bank deposit, yes, it's very liquid, right? So it is safe. SDIC protects 100K per bank that you have in a different bank balance. All right. Then also you have access to your funds anywhere, anytime. Right. So very easy, very safe. All right. However, they usually by default for most of the local banks 0.05%, unless for the higher interest accounts. Even the higher interest accounts that I recommend to my friends or family members to use, or even my clients to use for high interest account, they have a cap. They usually cap at 50K, 100K, depending on the banks that give a higher interest if you fulfill certain criteria over time. So if you hit those minimum already or hit the cap already technically, then you will not be so-called safe also, right? Because you don't get the same returns. And same thing, SDIC is also limited, right? 100K per bank. So even if you split across all the bank, there's a limited amount of funds that will be covered by SDIC, right? So, and also having easy access also means that you'll be easily able to spend the money. So some people like to lock money away or put it out of sight, out of mind, so that you can actually keep it and reserve it for certain milestones in life. All right. And if you put it in a bank balance, definitely it's a poor hedge to inflation because no matter how high interest accounts, most likely the average return you will get out of the bank balance will not be able to beat inflation. Okay. So this is the understanding of different codes, just sharing. All right. Okay. So main thing is for new investors or for investors itself, you want to know these few questions where then you can then evaluate what to choose or what to invest in. So how to invest? What can I invest? Is this a safe investment? And what's the best time? Okay, so how do you invest? Right. So first thing is you always have to have a goal. Right. The final goal may be retirement. But like I mentioned, right, there's many milestones along the way. So you can break up your investment goals, right? Or you can have a longer term goal at the end of the day. But in between, there will be short-term goals that you might have. So if you have different goals set already, then you set up different funds for different fund flow for those different goals. Okay. So when you have a certain goal in mind, then you can plan the investment that is utilized, right? So either you choose stocks, unit trusts, bonds, etc. And then you can also choose the timing to be entering or exit if you need to use the funds at a certain life point of time. So let's say I'm going to use the money next year, right? I got money set aside next year to travel. Will you be putting this money into a very high risk stock? You might not want to because you put it in a high risk stock, it's volatile. Within 1 year period, you might not find the exit that you want. Then you will not be able to exit, then you can get access to the funds to utilize for the short-term goal. For if a short-term goal, if next year when you utilize the money, you might be putting it either in a safer option or even in a fixed deposit that is locked up for 1 year with a guaranteed return. Right? So anything that have guaranteed return and maturity of 1 year might be a consideration for you. Right? Then you can also review your investments to keep whether you're staying on track of your goals. Right? So either a monthly, yearly, or events-based review. What is events-based review? Meaning that if there's any recession or maybe bull market, anything that happens that is significantly affecting the markets, then you might want to decide whether or not you can actually adjust your investment accordingly. Okay. So of course, in Singapore, there's different modes of investment, right? The most common that everyone knows is cash, right? So excess cash that you have that you set aside after you have already set aside emergency funds or cash line that you set aside, right? Then you have CPF and SRS. Okay, but CPF itself is limited. You cannot invest everything. There's a certain minimum that you need to fulfill. And if you trade CPF into stock and shares, there's also a quota. It's not 100% of your available funds. You can keep aside 20%, 20K first, and then you can trade 35%. Right, so it's not 100% of your above 20K balance that can trade in stock and shares, but you can trade in other investment options as well. Okay, and SRS is if you utilize SRS for setting additional funds for retirement to get tax saving as well, then it's also one mode of your investment choice. Okay, so basically we have a lot of investment options, right? In current context of world, right? You have many things. But for today's topic itself, we'll be focusing mainly on just unit trust, money market fund, money account, stocks, and bonds, right? Things that we can actually do through the Poems account. Of course, if you have other modes or investments that you have, there's different things like cryptocurrency, there's FX, there's also even if you want to trade into alternative investments like collectibles. So there's different modes available, but today we'll talk about these few as a start, right? And so also for protection, so if you have investment side, you take protection. So we don't cover this today, but just understanding that when you have investment for long-term growth of money, you might also want to have a protection planning for yourself, right? So this is more for actually protection. People tell me, hey, actually it's more for older point of time, right? Because you have want to, you feel that certain events happen mostly at end of life or during the later stage in life. However, actually protection is more important at the early stage. Why? Because at the early stage, you have not yet accumulated enough wealth for yourself, right? So if you have enough wealth, technically protection not that needed. Why? Because you already have enough wealth to sustain your events like illness or anything, right? Or maybe house fire, anything. You have enough wealth accumulated, you have already enough to cover for all these events that might happen. But at the early stage of life, you do not have enough wealth accumulated. So you need protection, you need insurance to help you cover such certain events. So you're paying an insurance premium, but you're getting protection for those negative events that might potentially occur. But if you already invested the rest of money properly, you should have already accumulated enough wealth in the later stage of life that you can actually cover even if you don't have enough protection. So that's the left and right side of things. So it's whether you focus on it early on or you only want to look at it in the later stage. Okay, so unit trust is a very brief covering, so we don't really cover unit trust per se. But then I understand that basically it's a fund, right? So normally it's professionally managed by a fund manager, right? You have BlackRock, you have JP Morgan, you have like maybe Amova or different companies. Even UOB, AM have theirs, and Philip also have our own, right? So fund managers. So you buy into unit trust, you'll be pooling your funds with other investors that have the same mindset or same investment goals as you, that they believe in that mandate of the fund. So the fund, let's say, is buying into all Singapore REITs, or the fund is buying into all of US broad base. Then you are investing into the same fund that everyone has the same idea that I want to buy US. So you have to agree with the fund's objective. Then you choose that fund, and then you'll be put for all the funds to be put together to stay invested in those underlying assets, right? So basically, you can give you a diversification. It's professionally managed, right? You have lower cost than you individually buying every single asset inside the unit trust usually, and liquidity is usually more assured, right? Because you don't have to say let's say you have a fund that has hundreds of shares inside, it's very hard for you to manage hundreds of shares individually yourself. All right. So there's a lot of funds available, right? And unit trust also have some that is available through invested for SRS and CPF as well. Okay. And that's why it's more important because unit trust can trade the remainder, the full amount of CPF above 20K minimum balance for OA. So you 100K in the CPF OA, you can trade 80K everything into unit trust. But you cannot trade 80K into shares. So unit trust is one of the options that at least can engage fully your CPF if you believe that you can actually outperform the CPF return, which is 2.5% guaranteed by government. Okay, so there's different category of unit trusts, money market fund, bond funds, balance funds, and equity funds. Okay, so another service that Philip have, if you do actually want to have your own in-house fund manager, so-called, that you want to ask to curate your own objective, because you find unit trust don't have something that you want. Maybe you want certain specific criteria for your own portfolio, but unit trust don't have one that is suited for you. It's not tailor-made. So you tailor-make your own funds. If you have a sizable amount of pool of funds that you have on hand, you can look for us. We do have this service, all right, but I'll not dwell too much on this today. But in case you are interested in tailoring for your own portfolio, there is a fund that we can do for you managed by our side, but then there will be fees involved as well, right? But the more common one that we have for our clients in Philip, of course, is just stock and shares, right, and ETF. So we start with stocks, right? So mainly we name them actually as usually equities, or some people call it shares, right? So basically, owning a stock or owning an equity or share is that you have an ownership, part ownership of something. So if that something is referring to a company, then you have ownership of the company. If it's ownership of a REIT or property, right, then you have ownership of that REIT or property by definition, right? And your main return or your main source of generation of income from this method is through either dividends, which we call it income, or capital appreciation, which is the price increase. So you buy low, sell high. So there's a capital appreciation itself. So of course, there's many shares, right? So I just use a random stock photo that you have different brands that you're familiar with, right? So a lot of investors ask me, what is the stock I can buy for my investment portfolio? So something I always share easily is that if you find it hard to select stocks or select companies to invest, right? One good starting point to look at is stocks that you are at least aware of or familiar with. Not that you choose to invest all of them, but at least you start with the filtering of stocks that you are aware of. What I mean by that? Some people tell me, hey, maybe friend A told me that I can buy this Hong Kong share, but I totally have no idea what this share is doing. But someone tell me that it's good. Then I look at it, I think the stock looks good, uptrend, and I buy into it. Then they might lose money because they're not familiar what's it. So if you are familiar, at least you know, let's say Google, and you read in the news that there's some news of them having new investment or new earnings yesterday, or you find in the news that, hey, maybe I use Apple iPhone every year. So whenever there's a new launch, at least you are aware. Because you are personally engaged, you are using their product, you are aware of the new releases. So you're also aware of whether the new release was performing good or not good, which will affect the share price. So if you start off with this type of idea to select your portfolio or watch list, you have an easier time to curate or to select your own portfolio for yourself. Okay. So next one, other than stock and shares, if you don't want to have individual shares too many, right? Very hard to invest all your funds, or you don't want to be too concentrated into a few counters only. You can look at ETF. ETF is basically an exchange traded fund. So a fund similar to unit trust, but instead of it being closed-ended or being on a one-day, one-time pricing, it's an open-ended fund that is usually passively managed. Usually, not all. Some ETF are actively managed as well. But the main idea is that these are all funds, ETF, that is traded on an exchange, similar to a stock and share. So the cost to you will be the same as stock and share. Commission-based, trading-wise, putting in order and selling, buying and selling, is the same idea as placing an order for a share or stock. Okay, and the ETF can be having different underlying. Can be a basket of stocks, can be a basket of REITs, can be a basket of bonds, or a basket of commodities even, or just one commodity. Let's say just oil or just gold, right? So it can be a different underlying, but basically it makes this fund that is now traded on a stock exchange like a share. So it's more easily accessible for you. What you might find that, hey, I want to buy gold, but I cannot be queuing up at UOB every day to buy physical gold. But now I buy into an ETF that track the price of a physical gold and it's backed by physical gold. So buying the ETF of a gold is like buying actual gold because it's backed by physical gold. But instead of you holding the gold itself, you're holding a share, right? Or let's say even for cryptocurrency, you want to buy Bitcoin, but you find it very hard, not very familiar how to buy cryptocurrency. There's a cold wallet, the online wallets, right? The exchanges. Then you find it very unfamiliar to you. So you want to actually buy it through online. There is exchange ETF for even Bitcoin, like IBIT, right? So there's different ways to get engaged for different assets that you at least have access to these assets that you want to get invested in through an online, very liquid, can buy and sell, and check the pricing easier. Okay. So basically, if you buy individual shares, like you're buying only one thing, right? At a time. You choose one thing at a time. But if you buy ETF, they are like buying a pre-packaged fruit basket. You cannot select what's inside the basket. You can see, then you choose whether you want to buy the basket. But you cannot say, hey, the basket like that, I'll take out one thing and put one more inside. Cannot. It's a pre-packaged. Okay. So if you really want to customize, then you must do it yourself. You must do it individually, like the first one, individual share, make your own basket. But that's more troublesome compared to you having a pre-basket already packed for you, and then you at least can select. But if you choose the basket version, let's say if only apples points, right? All the apples point inside the basket, you at least have other fruits inside. But if you buy individual one and you only buy apple, and apples point, everything gone. So that's something to think about as an analogy. Okay. So basically, we compare ETF shares unit trust. ETF itself is diversified, right? Same as unit trust. Individual shares are not, but of course you can buy multiple individual shares to get diversification, but that incurs more cost to you. For price transparency, both ETF and shares are exchange traded, meaning the price is always moving live in the stock exchange. So whenever the stock exchange is active trading, let's say in Singapore time, 9 to 5 is trading, you will see the price moving. Compared to unit trust, it's only one time, one day, one price. So it's not as liquid. All right. Intraday trading, same thing. If it's trading on an exchange, you can then buy and sell on the same day. All right. Sales charge, there's no sales charge per se, right? For ETF and shares, but there's management fee, right? So usually ETF, the management fee is less than 1%. Usually, not all, but usually, yeah. Right? And dividend, they can issue out dividend for all three, but doesn't mean that they will give out dividend, right? Meaning that ETF, shares, and unit trusts are all enabled to issue out dividend if the underlying assets give out or if the fund manager wish to give out, right? And you can trade it through a broker, right? Through an exchange broker, yes, for this two. Unit trust, no, but our platform Philip can, right? But it's not through the exchange itself, right? But note that both ETF and unit trust, other than management fee, there are also other fees involved, right? So ETF and shares will be the brokerage charges. You buy and sell shares, there's brokerages, commission. So there's no charge, but there's commission. Unit trust is just a one-time onboarding or selling sales charge. Okay, so different nature of the naming of it. Okay, so in Philip also, we also issue out chances for clients to invest regularly. And one of them is called this thing called share builder plan. If you want to have a regular fixed amount invested plan, all right, so you can buy selected SGX listed stocks, right? So we'll open up for non-SGX listed stocks, but not yet, right? There's works on it, but currently this SPP plan is only for Singapore listed stocks. But Singapore listed stocks does not mean that you are limited to just Singapore companies. Because like I said just now, the SDR. So there is also SDR inside the share builder plan, meaning that you can buy companies that are not listed in Singapore, but through the share builder plan, through the SDR mode. So example, Alibaba can buy, for example, Bank of China, and all that, right? So there are companies that's not in Singapore, but tradable through regular investment through the SDR itself, through SP. Okay, so if you are new to investing, you are new or you want to have a very small amount of regular investment, you can start as low as $100 a month. Right? So you compare to say, hey, investing I thought need a few thousand every time. No, you can start as little as 100 a month for one counter. So if you want two counter, of course you need $200, 100 per counter, right? So that's $100 the minimum per counter basis. Right, so if you don't want to track and invest yourself, right, you don't have time, then having a plan to help you to regularly invest by deducting your money through gyro and investing at the same few day or same day of the month, every month, then it's one way to do so. Okay, so if you're looking to accumulate for long term or looking to help to build a fund for your children, then this one method is quite popular through for yourself. Okay, so small startup, I say 100 a month per counter. Can diversify. You can change between the counters available. Currently, there's already around 97, 98 counters. So it's not just one counter, two counters, this thing. It's 90 something counters to choose from. So like DBS, Singtel, UOL, all of them are available as well, even estate engineering and stuff like that. Okay. And also one more thing is that when you receive dividends from your portfolio in the share builder plan, you also reinvest. The dividend will be taken as cash in the plan. You add on to your choice of investment in the share builder plan. So let's say you're investing in DBS, right? So the dividend issued out from DBS, you hold as cash inside the plan. You add on to your gyro amount that you invest every month, and then you invest into your preferred counter. In this case, if DBS, then you invest in DBS. There's no lock-in period, meaning what it means is that you can choose to sell. If you really want to sell, let's say you invest for 6 months later, you want to sell the holdings, you can do so. Even you invest 1 month, you want to sell immediately, also can. So as long as the investment is made when you hold the shares form instead of the cash, you can only choose to sell if you want to. But just take note of there's potential cost involved, that whether it's worth it to sell short term or not. Right? Hassle-free because it's gyro deduction every month. So there's no need to manually transfer money into the account. Okay, so why we choose share builder plan or something basically is to give you a regular investing mindset, right? So that was share builder plan. But this is why, right? So first thing is you don't time the market, right? You don't time it, I believe the market will go down, so I wait for a while. But then if you wait for a while, maybe you get busy, then you forget to invest. Your money is left in the bank balance, right? Then you might miss the market rebound. By the time rebound, I wanted to invest, but I missed out. So I thought, hey, rebound already, let me wait again. Let me wait for the next market correction. If you keep waiting, then you will not be invested in the market. So you will sort of lose out because you are trying to time the market. You're trying to wait for the correct timing to enter the market, right? So if you actually start early, you can start as low as $100 a month. And then when you have money set aside for investment, you then have this thing called a dollar cost averaging method to enter your investment portfolio instead of you buying through lump sum. Okay. Yeah. Let me see. Okay. Okay. Before I go back to the dollar cost averaging again, I think the sequence I mixed up a bit. So there's also bonds itself, right? So bond itself is a debt instrument. It's not a share, right? So it's another type of investment item you can choose. So bonds usually have two types: government bonds and corporate bonds. The government bonds things like T-bill. You might have heard of T-bills, treasuries, right? Itself, or even T-bonds, right? Treasury bonds from government, right? Short term, 6 months, 3 months, 1 year, or bonds that can be 2 years, 3 years, even up to 10 years, 30 years. There's options like this available. Singapore, US, or even other countries. All right. So when you have a bond that's a debt, it's like you borrow money to the government or to a firm, if it's a corporate bond, then they have to pay you interest, right? So this interest is paying you in the mode called coupon. They pay you an interest payment or interest percentage, but they pay through a coupon, right? So you can apply through online or through the SGX if you are buying for government bonds or even the Singapore savings bond sort of thing. But if you want to buy corporate bond, usually the minimum amount is larger. But they are also listed with corporate bonds, listed, right? They're trading in multiple of 1,000. So you have an Astral series, Astral bonds that is paying different returns for private equity breakdown of the bonds funds, right? Or you can buy into an ETF that's tracking on bonds. But if you're trading into an ETF of bonds, it's not the same as a bond, right? If you buy a bond itself, your money is capital guaranteed, right? But subject to potential default risk of the issuer. Meaning, if you buy a bond that's from DBS, okay, they have to pay you back the interest payment every 6 months or every year, right? Depending on the bond structure. At the maturity, they have to pay back a full principal. They cannot run away unless the company disappears, meaning the company bankrupt. If not, they have to pay you back. So if you buy it from bonds from names that you're comfortable with, you buy from DBS, you buy from OCBC, your risk of this company defaulting is a lot lower compared to if you buy, let's say, from Genting Singapore, you buy from, let's say, even more obscure firm, right? New startups, then you might be have a higher risk. So what you get from doing so, why you want borrow to more risky names is because these people that are riskier names, they usually give higher coupon or higher interest because they know that they are of higher risk. So they must compensate you for you taking on more risk, right? So they give you more returns, right, as an interest. Right, so this is something to take note of. If you're interested to find out more, you can look out for a trading rep. So basically, the dollar cost averaging, back to this again, is that you are looking to invest regularly and you spread out so that you can have a different entry price, average price. Okay, so this is the idea, right? So if you do a lump sum investment on top, $8,000, right? You buy over this period of time, $10, $14, $9, 13.5, 8.5, 7.5, 10. Right? This is the price movement over time. And over this time, you invested lump sum 8,000 at $10. So at the end of the period, you are still $10. So your lump sum is zero. Okay, you never lose, but you also never earn. But if you buy regularly every month $1,000, you buy 100 shares on the first one, you buy 1,000 divided by 14, less number of shares, $9, you buy more shares. Because it's cheaper. But investment amount is the same every month. Okay, so this one, the average cost is now lower than the top one because there's time below is more. Time below the average is more. The return is 4%, this is zero. Of course, this is the skewed example because if it's an uptrend all the way, lump sum will do better because you already invested everything one shot if it's uptrend all the way. But over here, what it means is that it's trying to stagger across a volatile period. So at least you're entering more on a cheaper days, entering less on a more expensive days. But if it's uptrend all the way, you keep entering less and less. But then basically your portfolio is still going up. Just that it's less volatile compared to the lump sum method. Lump sum method will receive the full volatility of the market. Whereas the DCA method will even out a bit. You will not have a full volatility engaged. Some more, the issue is that lump sum investment, one more requirement is that you need to have the one lump sum available. Some people want to invest over time because your money comes out in tranches as well. From salary bonuses, or from different reasons, right? That you don't want to engage everything one shot. Okay. Okay, this is another one example. If you have $10,000 invested in S&P in 2003, not that far away, 2003 to 2022. Okay, if you don't do anything, you stay invested all the way, 10K lump sum, you get this. If you miss out 10 days of the market, 10 days only, out of this 20 year, you miss out 10 days, you lose. You only earn this much. You lose out 20 days, you only earn this much from 10K. Okay, so I give you an example. 17K, right, from 10K is 7K extra. So that's 70% return. For 20 years, average out maybe around 2 to 3% compounded return. Right? Not that bad, but also not great. 2.29K, you're looking at maybe a return of this is what 10K, right? So that's near 200%. 20 years, around 10 to 15%. Compounded maybe around 7%, 9%. Right? So this is a return itself. And this is the days in the market. The day that earn the most return of this time period that's mentioned. So if you see very carefully, right, it's fine. 208 October. Do you find anything familiar with 208 date? Is within the financial crisis. Right? Next one, 2020, March. Also third best day. So which day is this? It's part of COVID. So if you escape based on different dynamic, let's say you are lump sum, then you always say, hey, I want to exit when there is a correction or market plunge or a sudden scare in the market, you exit. You realize that you will lose out a lot of these best days. So doesn't mean that you exit, you definitely do better. But staying invested and doing nothing, you might be doing better. Right? Same thing for even those that are investing in gold. Even though gold price went down a lot from the highest point already, but if you invested very early on a few $100 or $2,000, now you're still earning a lot compared to those that enter and exit consistently. Okay, this is how investing works. This is trying to just show that staying invested is more important than timing the market. Okay, another thing is that you compound money. You reinvest, you compound the money. So you invest 10K and you have a 7% return per year, and you withdraw the money 7%. You withdraw the additional 7% and you spend it elsewhere. But once you regularly receive it, right, you're gonna spend. Maybe I have a better meal, I go travel, whichever. 10K per year invested. First year my portfolio 10K. earn 700. Second year, my portfolio 20K, earn 1,004. Third year, my portfolio 30K, earn 2,001. So you see, it's a linear graph if you're earning and you're spending the dividend. Linear graph. But if you don't do that, if you actually reinvest, compound, your dividend that you receive, you don't use. You reinvest and stay invested at the same fund, close to 7%, assuming same thing, right? You realize that you actually earn more than double in the return, right? So this is the thing. So this is assuming if you do not do anything, mean there's no additional investment, right? So it's just your return itself. Your principal is the same all the way, like 10K. But your impact is even higher if you regularly invest the same amount every year. Okay, it's even higher. This is assuming if it's the same principle all the way. Okay. Okay, so next thing to understand the concept is that other than knowing the DCA, why you must stay invested, all right? Another one is that you need to understand the cost to you to choose different funds or different investment assets. So you need to understand cash and money market are the most liquid, and then can withdraw. Or maximum your withdrawal is usually up to 1 day, a delay. So for example, you hold through Philip, money market fund, you withdraw, same day we give you money back. If you hold money market fund through other platform, maybe you need to sell the money market fund, then you withdraw, selling 1 day or 2 days, then you withdraw the money out. Cash is instant. You put it in the bank balance, same thing, instant can change money. Even fixed deposit can negate instantly. But if you buy and sell shares, US share settlement 1 day, Singapore share settlement 2 days, Hong Kong also 2 days. Okay, so you need to know the settlement cycle of the different business days for different counters that is converted to cash. Of course, if you have real estate property, it's going to be a lot more. So if you say me, I'm invested, I prefer to invest into property. Right? Singapore, very good property. Yes, it's very good. But if you lock up all the money in property, it's a bit harder for you to have liquid cash or liquidity when you need money. So don't put everything in. Even if you really believe into property investment and it works for you, you earn consistent rental, right? It's good investment. But if you want to have a liquidity concern, then you need to then evaluate your portfolio. How good is it that you can receive liquidity when you need so? Right. So of course there's a backup plan. For property, the backup plan is that you can mortgage property. The bank might give you, but also need time. It's not going to be 1 day, right? To withdraw money out of that. So you need to have liquidity that you need to receive. So some people, why there are more people investing in the REITs? Because REITs is investment portfolios that is in property. You are still a property investor, but not directly in a company in the what you call it, the deed itself. You have the ownership of a property through a REIT, right? So into the malls, into the commercial buildings, stuff like that. Okay. Of course, another one is also if you have private equity, art pieces, collectibles, right? Also have different liquidity itself. Okay, so main thing is assets change to cash. This is the liquidity idea. And then why you want liquidity is that you want to have the easy access to funds. You need to be quick and you need the lower spread. Lower spread is something I talk about. If you hold physical gold versus you hold gold in ETF, ETF you pay management fee. However, if you hold physical gold, the spread of buying and selling is very large. So let's say you buy physical gold, there's 1 gram. Okay, 1 gram. You buy, maybe you need to spend 220, 230 currently. But you sell instantly, same day I buy, I sell instantly, 1 gram, you only receive back 180, $40 spread. This is a very high, 20% spread. If I 10 gram, maybe 2, 3K, 2K plus, 2.2K or so, you sell instantly, maybe 2K 100, 2K 80. Less in percentage, but still a large spread. So spread itself is something that will take very big importance in your calculation of an investment choice. Even for investment into stocks, stock spread can be large. If let's say the stock is illiquid, there might not be enough buyers and sellers in the market, then the spread can be large as well. Later I'll show in some screenshot. But if it's liquid, the spread will be very narrow, directly the next bid. Buy at $22, sell at 23.01. That's the bid and ask, right? But if it's an illiquid stock, maybe the bid can be, let's say, 10 cents, then the ask can be 15 cents. In between, there's no one queuing. So it's a very bad liquidity for those counters. Okay. So just to let you know, basically, this is in theory, the stock market usually move in before the economy. So you see the news article say, hey, economy is going to a bear market. All right, economy is negative. Usually, stock market has already preempted. It's already should be in a bear already, right? Same thing. If you find that, hey, economy says that the market is going up, all right, the economy is doing very well, right? Your GDP is growing the fastest rate in over the past 20 years. Then you want to invest into stock. And you realize it's normally too late. The peak usually have already reached when you see such news. Same thing like I say the gold price, when you start seeing the news article show all the auntie uncle go queue up at a different jewelry shop to buy gold, that was a peak. If you recall, you go and take a look. The news date, that article that released on when Singaporeans go queue up for a jewelry shop with gold, those gold that the gold investment choices from the different jewelry shop, that was the timing that week of the maximum price. After that, it just crashed again. So when you see things happen at a peak in the real life, that's usually the peak of the stock market is already over. Okay, so same thing idea in that. Okay, so this is just an idea of what is the investment choice. Usually, we believe that in a bear market, we're looking at more defensive and non-commercial, so not more of the staples, right? Not non-discretionary staples like your thing like healthcare, groceries will do well, right? So inflation, when there's high inflation, because usually at a very bull market, at a very bull market, right? Market is very good, economy is doing very well. Usually you have high inflation because everything is doing very well. So a lot of money is being spent. So inflation is higher. So when inflation is higher, usually in this stage of time, the next sector that will do well is those that will benefit or are okay to perform during high inflation, which is your commodities, your necessities like electricity, water, these sort of things. Okay. Of course, there's also others lah, right? Maybe like a new stocks, new growth companies, right? There's always that is relevant. Then in a upcoming type of cycle, usually you have your high tech, your medicine, your industrials, manufacturing. So you see manufacturing is doing quite well, right? When there is more increasing in the recovery of the economy, because people have more deals, they have more production, demand. So let's say now you see like what was the thing that moved first a few years ago? Nvidia, right? For US stock, Nvidia moved first. After Nvidia moved out a lot already, but who else moved next? Computing power, the AMD, Intel, right? Because after Nvidia, the demand went in, order book went up. There's a demand, but in correlation, when you use a lot of Nvidia chip, you need also computing chips. So computing chip also went up in demand, correlated demand, right? To make the whole data center work. After computing went up, to have the computing power work, you need what? Memory. So memory went up. So this is the current stage. We are at the late stage of this stage, memory stage. So all the memory went up. After memory went up, what's next? You need to fulfill all of these orders. So you need to have enough material. You need enough manufacturing power, right? So you see, if you realize a lot of their suppliers are also going up, because when these companies get locked in contracts, enough demand for next few years, they will spill over their demand to their suppliers, because they need to get enough supplies to make the same production, right? And they're also investing into more capacity, manufacturing capacity. So you see Micron opening factory, you see Tesla, Nvidia all opening factory for the same reason. Okay, so it's all correlated. So it's more of a cycle by itself. Okay. So basically I'll share on the platform. So this is a Poems 3.0 mobile, Poem Mobile 3. If you have not downloaded before, please download, right? Because Poem Mobile 2, the older version, might be phased out anytime. Poem Mobile 3, right? Basically, if you log in, homepage, below you see there's a home, the key 6 buttons, right? So first thing you need to do always is that you need to have your own watch list. So you go to the watch list, you can add counters that way through the add button and search the name. Or if you don't want to add that way, you can just go to the markets and then press the heart button to actually add counters that you like or names that are highly traded to your own watch list. Okay. So of course, if you want to fund the account to trade, then you also need to pay now under deposit, pay now, in and thing. Normally we recommend pay now for Sing dollars. Next one, if you already choose a stock counter, this one in this case choose DPS. Choose a stock already, then you can key in this is the limit order normal, the price that you want to buy and sell. All right, and then also you look at the quantity. Then there will be a mode of payment. Then you realize that there's this gross value. So this gross value does not include commission for now for our portfolio platform. Okay. So when you look at this one, right, here don't show, but on top of this, just above this, in the stock price itself, they will show a bid and ask price. Later I see the next screenshot got shown. But other than that, you can also go to stock analytics, right? Look at the profile of the company. If you are familiar with the firm, you normally know this information. But at least if it's a stock name you might not be familiar with, but when you add to your watch list, you can actually go here to have a quick understanding of what this company is doing, how the company is doing, what is the analyst results, what's the analyst direction. Then you can also compare the performance of the company through their competitors. Okay. So that's what I mean. So you see over here, right, in the stock price, right, this is the stock price, 73.52. 5152. So why is 52 here? 52 means that the last traded price was 73.52 at this point of time I screenshot. But at the point of time also, the highest bidder to buy queuing up is 73.51. The lowest price that queuing to sell is 73.52. So let's say now I'm a buyer. I want to come to the market. I want to buy. I want to buy at 73.5. Can you get it immediately? Cannot. Because the lowest price a seller is selling at is 52. So if you want to buy immediately, I must buy at 73.52. And if you note, it's not that I can buy and sell any volume I want at that price. It's up to the Q volume. So in this case, the Q was at 7.4K. So if I want to buy within 7,000 shares, no issues. But when I buy 10K shares, not enough. 10K shares, 73.52, not enough. But I can wipe out whatever supply there is at 52, and I leave my remainder in Q. I can do so. Or I can just go straight up to a higher level. So what's the higher level? You see over here? If you're not sure, you scroll down, there's a market depth. Market depth show you what's the different price levels, what's the volume. Okay, so market depth can show you, let's say in this case, at the point of time, there is screenshot, right? There is more volume there. So I think this is a 73.515253. All right. At the point of time, screenshot is 50.51 instead of 5152. So if I queue and buy, let's say 30,000 shares, right? I'll wipe out this one, and this one, right? To fulfill my order. And still have a shortfall. So if I want to really consider and do 30K shares immediately, I will need to push up all the way here, which is 4 cents. Okay, so in this case, 4 cents is not a lot for 73.5. That's the ratio in percentage. But if you look at the smaller price counter, right? If you need to go up 3 or 4 levels, it's a big spread. So liquidity is one thing. So how liquid is this company in the market? Right, so for DBS case, it's very little volume because it's very highly priced. So even a few thousand is a few 100,000 already in actual terms. But if you look at the counter, there's maybe 10 cents, 15 cents. Right, 100K shares is just 15K. Then if you need to go a few levels, I want to buy 1 million shares to get a 150,000 investment. You need to go a few levels, then your spread is very large. Then you might be losing out through the spread. Okay, so that's a consideration to make when you are looking to invest, right? So after investing already, you want to find out more or you want to log in, you need to log in through a digital token. I don't work on computer. I don't use the app. I use the website to see. So, or use a tablet to see. When you log in, they'll ask you for a 2FA. You can click on the digital token here to find this code. Then enter the code inside your tablet or laptop. You can log into the computer or tablet itself. Right? Or if you scroll down, you find that there's a few forms. You want to trade in the US, you need the WA form. You want to trade in the US and see live pricing moving, you need to have a market data subscribe for live price. Even for Hong Kong currently, for live pricing for mobile is free if you apply through the mobile itself. The corporation or the RWS to trade foreign shares, particular update. So there's different things inside the Me tab, right? And at the scroll at the most bottom, there is a help center. Help center can give you the different parties to call if you have inquiries generally, general inquiry, or product level inquiry, or looking for your own broker. Is over there at the Me tab and the most bottom side, under help center, under call broker, is you find your own broker. Okay. So any questions that we may have?
Sure.
Yeah.
Who manage ETF?
Who manage ETF? Okay. So ETF itself, right? You mean the fund who manage it, right?
Are there different companies manage different ETFs?
Yes. Yes.
If the company is not trustworthy, will the company go broke and then our money goes?
Okay. So ETF, right? So who manage it and whether the money inside there is safe. So in Singapore listed ETF, right, similar to unit trust, the fund manager does not hold on to the assets. The fund manager has to hold the assets through a trustee bank. Okay, that's one thing. But another thing is that usually you find that if a fund manager is not trustworthy or not reputable, per se, the fund will be not popular. When the fund not popular means that the size of the fund is very small. Very small means what? Illiquid, less people trading, and the name was very niche. So usually for these not popular counters, they might have a very strong purpose or incentive that you must want to invest in them. Meaning that it must be very niche. Maybe example, or this ETF is to trade you to give you leverage returns of specific stock. Maybe let's say example, leverage return of Micron. So Micron move up 1%, this ETF move up 2%. Then at least they have a purpose that's enough to attract people that want to consider this ETF. If not, usually for the larger ETF, you have names that are popular, like your Lion. Lion is from under OCBC side. There's last time Nico AM, now it's called Amova. For Singapore-based names, there's Philip Securities one, we call it Philip Capital, our Philip Capital arm. Then you also have your DBS don't have them directly, but there are a few different names. I think Lion, then UOBAM. UOBAM have their own name as well. So other than these Singapore names, there's also bigger names, right? That's in Singapore, like State Street. Your STI ETF that you know of, the more popular one that people trade is from State Street. It's a US firm, but it's in Singapore tracking the State Street SPDR ETF because the SPDR is from them. Basically, State Street, if your name don't sound familiar to you, you heard of the SPDR, the index is all under them. Right, so they are the firm tracking that index. There's also FTSE, which is another index, the people that track the index, so they're different issuers. So in Singapore, we have other foreign issuers, like CSOP is one of them. There's different companies coming. But if you go to even overseas ETF, then you have things like your BlackRock one, right? iShares, you have HSBC, you have JP Morgan, all that. So you would ask me whether or not it's safe, it depends on where it's listed. First thing. So what's the structure? So Singapore, very safe. Singapore got MAS covering, looking after, and also the trustee and manager are separate. In US, can be reputable, but the fund managers can hold their own funds, meaning they'll hold own assets for the fund. Can be the same company. So really, if anything happens, then holding cash together is possible. So that is a higher risk, yes. But because of that structure, they can charge you a lower fee. Singapore, why fee is more expensive? Because not only do I have to pay you the management fee, the fund manager has to pay the trustee. Trustee do this service not free, so you must pay. So these Singapore listed ones are all more expensive for a reason. You want a trustee structure. You want a safer structure, you need to pay more. So there's a give and take. If you believe in them enough and you don't mind buying an overseas ETF that's in the same investment framework or same investment objective, you can buy a US one for cheaper management fee. But if I want to have a safer structure, then you buy Singapore because safer. You know what I mean? So there's a different mentality to your choice of investment in that sense.
I just want the one that track STI.
Yeah.
So
STI, there's two. Currently, there's two. STI ETF, State Street, right? Second one is Amova. Amova STI ETF. The Amova got two, right? One is $D. One is $A. Okay, what is A and D? D is distributing. They give out dividend. Singapore STI give out dividend around 4.7%. 4.5, 4.7, 5%, that range. For A, they accumulate. Instead of giving you dividend, they reinvest directly into the ETF. So if you want to make it easier for yourself, I don't want to reinvest myself manually. Because got commission costs, dividend so small, and reinvest very troublesome. 1 year, 2 times dividend, very troublesome. You buy A, means that they reinvested for you. So you find why A more expensive than D for a reason, don't need to worry. Right? It's not that they scam you, it's because A is accumulating, D is distributing. All right, so that's the thing for what's the STI there.
So So it's transparent because what happened last time I buy unit trust, I don't know what's happening.
Yeah.
Market go up bit, it pay me later. But now I know it's SPI. I know how many percent going down.
You can see, yes, they have to issue their daily breakdown of the holdings, the percentage. It will show you. So ETF is a lot more transparent. Like I said just now, transparency. More transparent. Fund unit trust, they track an index, but they do not have the same components as the index. Meaning that let's say S&P 500 or 500 shares, and you move up 1%. You find that in my unit trust track the same S&P 500. But doesn't mean that my fund have 500 shares. Doesn't mean that it's the same 500 shares. So the returns can be different, very different. It's just that I'm tracking that. But if you buy an actual S&P 500 ETF that is mirroring the index, this more 1%, here more 1%. But 1% already, minus already the fee. So maybe like 0.99, 0.98, this sort of thing, right? So same thing for STI or S&P and all that. There'll be a tracking difference error and all that, but basically it's that. But if you want to find out more about the ETF side, you can join our specific ETF topics seminar, webinar. Right? I think your questions might be better answered there. Someone have a question? Yeah.
So for ETF, the best choice is if I have to invest in an index fund, it is STA, which is called as like State Street.
State Street State Street SPDR STI ETF.
Index.
The full name. Yeah.
What is the for other one? AMOVA?
AMOVA is I forgot the full name. AMOVA Singapore Time.
Singapore STA ETF.
Yeah, right.
Okay.
Singapore STI ETF.
Okay.
Then there's a $A, $D. Sing dollar A distributing,
Yeah.
Sing dollar D distributing. Yeah, two choices. But it's the same thing. The same fund, just different way of distributing dividends.
So just buying the share of key the
Key the code. Same thing as now the DBS. You key the price. Quantum for ETF minimum lot one share only. So I buy 1 share, 7 shares, 10 shares, no issues. There's no minimum lot size like the normal share 100 shares. You buy DBS now 100 shares, soon to be 10. Now 10 already. Now 100, soon to be 10. Then you buy ETF, there's no minimum lot size. 1 share is that. So I buy gold, I want to buy SPDI, STI ETF or that 1 share is that. But of course, don't buy 1 share lah. Your cost very weird lah. Because minimum, even though commission can be very low by percentage basis, very low. But SGX got this fee called SI fee, minimum fee 35 cents. You buy an ETF later $1, then you pay 35 cents SI fee. No matter how cheap commission is, you still need to pay quite a lot in ratio. Yeah. So check your fees involved, then you buy a suitable amount to your investment portfolio. Like 100 a month or 1K a month is fine. But $1-2 a month, they're not worth it. Yeah. Any questions?
Just like the earlier slides,
Yeah.
you mentioned that it's possible to transfer from CDP to
Yes.
Philips.
Promotion, yes.
There's a promotion.
Yeah.
How about transferring out
Yes,
subsequently?
also can.
Penalty.
Not penalty, the fee. Yeah. So transferring out is $20. So $10 from us, $10 from CDP. Even CDP charge a fee to transfer.
Accounted.
Yeah. Per counter basis. So let's say you have 3 counters, DBS, OCBC, UOB, there will be 3 counters times 20 times the plus GST.
Actually, I got CDP one amount.
Yeah.
I could put in one amount.
Yep.
So it's not the same.
If it's a different account, they're not the same.
No,
If it's the same account, then yes.
my going go to CDP eventually.
So if you buy, if your account type, there's different account type. There's some account type is Cash Plus, for example, is holding the assets with us in Philip. If you buy, you open a cash management account and you buy through Philip, then yes, you go to CDP. But only for Singapore shares. Same thing if you buy US shares, no matter what is with Philip. It's not in CDP. CDP only takes Singapore shares.
Because I know my CDP is amount.
Yeah.
I thought everything's there.
Yeah.
Philip this amount, which is smaller, do they overlap or totally?
Depending on your account type. I cannot say for sure. You need to know what's your account.
They could have what from other
Correct.
Yeah.
They bought from others, so they want from other daily. Can I say all those who Philip actually under CDP?
No, not all.
Not all.
Depend on your account type, I said. So if your account park the shares in CDP, then it parks. If your account does not park in the CDP, it does not park. Some of the account type is everything is with Philip. Singapore, US. Some account is overseas in Singapore, in Philip. Huh?
No overseas.
I know. Singapore share also with Philip. Some account type is that. So I cannot answer you outright like that.
Can I ask
I need to know what is your account type.
Okay.
Yeah, you can. You need to know your account type. I don't know the account type, I cannot see. So it's like same thing. I go to a bank and say I want to open a check, but I only have saving account, cannot open check.
But this account type is
No, there's more than one. We have 7 account types here. Yeah.
So,
Mm.
if you invest through CPF or SRS,
Yes.
so maybe this for
CPF SRS won't have this issue because the shares will have to park into the CPF or SRS bank.
Yeah.
So you cannot see it through Philip. It's not accurate. You must see it in the investment account. Log into UOB, log into DBS to see what's the share name.
So
Then you sell that.
if I settle through SA, where it will appear?
SA.
Yeah.
SA can only trade in unit trust.
Yeah.
Unit trust only appear with the broker or platform you trade with. So
if I
shares will be in the respective bank, right? Unit trust, if you buy, is in the platform you trade in. So you trade in POEMs, you only see it in POEM. You cannot see it in the bank. You cannot see it in elsewhere.
But for SA, we are not linking the CPF with any bank, right? Only
That's why SA you only see it in the platform you buy in.
Right.
Yeah. Wherever you buy in the platform, you will see it. CPF cannot see also.
Yeah. So if I have a cash account instead of the cash plus, what are the limitations?
Cash, you mean the cash management account, is it?
Yeah, cash.
Cash management account have a higher commission than cash plus.
And I cannot trade in some of the
Can trade in everything same.
country, right?
Yeah, can trade, but then higher commission. But the good thing is, for cash management is that you can trade in advance and pay later. Cash plus is you must pay everything upfront. It must be a pre-funded account.
Okay. And also in the cash plus,
Mhm.
when you buy through CPF and SRS, you need to have certain margin limits, right?
If you need, yes, for cash plus you need to have a minimum amount inside the account.
The minimum amount based on that particular shares margin list of margins which are provided in your website, right?
The margin ratio. So let's say you want to buy DBS through CPF.
Even for unit trust or anything.
Unit trust, no. Unit trust is not marginable.
Oh, no margin. Only for stocks.
Stock and ETF.
So unit trust and ETF I can just directly settle even without any top up into my cash.
Plus, yes. Unit trust also not need. Unit trust also don't need to top up.
ETF? No.
ETF need.
ETF?
ETF and shares need to top up first.
Oh, okay.
ETF and shares are part of the equities trading. You trade on the exchange level,
Okay.
then they need to be pre-funded. For unit trust, that's not.
Even though I'm settling through
CPF SRS, yes. Because in case the CPF SRS reject your trade, then you'll be on a cash trade. So there need to be enough cash in the account to take up the trade as cash mode if the CPF SRS does not wish to take up. Because we cannot choose for CPF SRS. It's up to the bank. So the bank choose to accept, then no issues.
Okay.
If the bank reject, then we have cash trade, so we have enough money to pick up.
So for example, one particular share DBS, margin grade is 80%.
Yes.
How much I should have?
So you want to buy 10K in CPF, for example, you need minimum 2K cash in the account.
Okay.
Yeah.
But when I tried with like similar 2K, what example you gave, like I'm getting an error like revise the quantity to 0.
You top up 2K must be in already. If you top up today, now, through a bank transfer, if it's not yet in the account, then you cannot trade until the money appears in the account.
It was okay, sure.
Yeah, so you check. Because sometimes you transfer the pay now, but you forgot the reference number. So transfer is already made. The bank don't have the money already, but the account have not received the money yet. Then you need to ensure that the money is appearing in the live cash balance they can trade. But for using financing, which is the one that you're saying, to put only 2K to buy 10K, you need the money to appear for 1 day. So let's say I deposit 2K today, tomorrow then I can trade 10K worth of DBS.
Even for exiting the market for CPF.
Exiting don't need, only for buying. Selling, you need to ask your broker to increase the limit. Will do.
So my question is how to exit the market?
How to exit? You call the broker to ask a higher sell limit.
For CPF and SRS.
For a sell limit. You don't need to care whether it's for CPF or SRS. Basically, you want to sell CPF or SRS, you want to sell shares, you need enough limit. You need enough limit to sell.
So let's say I bought like 100 shares in January, I want to sell that in December. So I just make a trade for sell.
You need to call the broker. You need to call the broker to increase the limit for you first.
Well, because I already have it in my bank account.
We don't know. Philip doesn't know how many you have.
Okay.
You don't hold the shares. If you buy a cash funded share, and we hold it in custody with Philip, of course we know. So we will allow the trade to sell, go through, no issues. But if you buy a CPF share, the shares go to CPF,
But through
The same shares can be sold through any broker link to CPF. We cannot guarantee it's still there. So to us, to lower the risk, we normally want to verify with you that you are confirmed selling the shares from CPF. You have the risk on yourself. So you need to be careful that you are selling shares that you actually have on hand. Some customers, they sell one time already, let's say on Friday, they forgot they sell. Monday they sell again. What's 2-day settlement? They see the shares still inside the CPF on Monday. Actually, they sold on Friday already. But Friday sell settle on Tuesday. So you need to be careful. There's a settlement cycle. So you need to be sure when you buy and sell, you need to be sure whether your order is done. Some customers, they Friday afternoon they queue in, then by 4 p.m. not done. They thought not done, then they go sleep. Monday come up, they sell again. But actually 4:30 or 4:45, the order done. Then you already sold on Friday. And then you sell twice. Then you call me, hey, I got issue. I sell double and how penalty. I cannot do anything. When you sell over means there's an issue. So must be very careful of the quantity, especially when we are not holding the shares. If you hold the share with custody with the broker, it's easiest because we know you have the shares. But if you sell through CPF or you sell through CDP shares, then I cannot guarantee you have the shares. So I can only advise you to be sure you have the shares then sell. Then no issues. Yep.
Yeah.
Okay. Thank you everyone for joining. I hope it was useful to you. You can join our content specific seminar sessions or webinar sessions if you are interested for like other topic like ETF or fundamental analysis. Yeah.
This is moving to Nova 3.
Yeah.
Maybe because in Nova 2, before I submit the
The
trade,
trade. Yeah,
it's
the
on the top left corner,
Yeah.
current price. At that very moment, then I submit.
Yeah.
Then in Nova 3, you can't see.
You can see, but you need to scroll to the top.
Oh.
The trade button is still below. Then scroll to the top, you can still see the price. But because you scroll down to see everything and key password already, but don't press first. You scroll up again. Then you press trade, buy or sell. Yeah. What can be done? But I understand your point of view. I understand your point of view. But that's why some people why they prefer laptop or they prefer tablet, because bigger screen. Tablet can see everything in one shot. Everything can fit into one screen. Then you confirm. Yeah. Right, thank you. Yeah, okay. You check my colleague. Yeah. Thank you.